All right, welcome to the finale of our Explainer series. Today, we're bypassing all the filler and jumping straight into the tape. We've spent the last 7 parts mapping the hidden machinery of the options market, and today, we pull it all together.
You know the mechanics, right? You've seen the map. Now it's time to actually finish the playbook and build out your mandatory daily process. We are synthesizing everything we've learned into pure, actionable strategy right now. This is Teacher to Trader, direct, and numbers first. Let's get to work.
Section 3, Volatility Anomalies.
Okay, let's dive right into our final block of tactical setups, starting with Scenario 11. This happens when the term structure literally inverts right before an event. Picture this. You look at the board maybe 10 days out from a massive macro decision, and suddenly, the front expiry implied volatility is spiking above the back months. This creates a backwardation kink that is pricing in a very specific dated storm. But remember, and this is crucial, the options market is usually pricing the uncertainty itself, not the actual outcome. If that event passes and there's no disaster, you're going to see a massive vanna crush as the inflated premiums on those front-month options rapidly collapse.
But here's the cool part. You can actually extract the market's exact forecast here. The event day implied move literally equals the difference in IV between the expiries right before the event and the expiry right after it. You have to position yourself so an in-range outcome doesn't hurt you. Seriously, I cannot caution you enough here. Do not buy front-month options at peak insurance prices right before an event. You are paying for a Category 5 hurricane, and if it turns out to just be a rainstorm, Vega loss will absolutely destroy you, even if you get the direction perfectly right.
Now let's break down Scenario 12, which I call the breakout alarm. This triggers when 30-day realized volatility violently crosses above implied volatility. Think about it. For months, the income trade works beautifully, right? You're selling premium, playing mean reversion, assuming IV is just rich. But the exact moment RV crosses above IV, the tape is moving more than the options price. Insurance is literally cheaper than the storm that is already happening outside your window. The income trade's edge just violently inverted. This confirms a massive regime change, and you must immediately pivot to owning options and respecting the momentum.
Moving on to Scenario 13, the volatility divergence. You look at the broad market VIX, and it's sitting in the low teens, looking totally benign. It lulls you into thinking everything's fine. But then, you glance at the tech sector, the VXN, and wow, it's running 8 to 10 points hotter. That is a loaded spring. A calm VIX can completely hide a screaming sector vol divergence, where institutions are frantically buying concentrated protection. If you're a tech trader using the broad VIX as your health certificate, you are looking at the wrong insurance index, and you will get blindsided.
Next up, expiry magnets and unwinds. Let's shift to where market gravity and systemic fragility just completely take over the tape.
11 a.m. Mark that down. That is the exact time on expiry Friday when you absolutely must start respecting the massive open interest magnet, kicking off Scenario 14.
The Friday magnet is purely mechanical. Dealer long gamma at big strikes peaks on expiry day. So as we grind toward that massive open interest strike mid-morning, it's like the index gets trapped in its orbit. Every 10 to 15 point deviation just snaps right back. Your job here? Fade small deviations back toward the pin. Never, ever initiate breakout trades against this gravity in the afternoon. Any extrinsic value on short-dated options gets ground down to 0 exactly where we are pinned. But keep in mind, this entire structural magnet evaporates by Saturday morning. Come Monday, we're looking at an entirely new map.
And all of this builds into our final and honestly most dangerous situation. Scenario 15, the crowded short vol unwind. Here's how this cascade mechanically plays out. Step 1. Years of low IV condition the crowd to just mindlessly sell premium. Step 2. A seemingly modest 2% down day arrives, pushing just outside the calm regime's normal range. Step 3. Short vol positions, vol targeting funds, and premium sellers hit their margin thresholds and stop losses all at the exact same time. Step 4. This triggers forced vol buying and forced underlying selling. This ignites a reflexive spiral that is completely disconnected from whatever the news is that day. Dealer negative gamma amplifies this mechanical cascade, pushing vol higher and price lower, which then just forces the next tier of traders to cover.
So the crucial takeaway here, and burn this into your brain, is this universal rule. The strategy that worked the longest with the least volatility is the exact one whose unwind is the most violent. When this reflexive unwind ignites, you either stand aside or you trade with it. Do not try to catch the knife on day one just because it always bounces. Catching the knife in a negative gamma cascade is career suicide. It will overshoot every reasonable target you have.
Part 7. Process and the pre-trade checklist.
All right. We've read the market's footprints, we know the scenarios, now we have to pivot to the actual daily operating procedures required to execute this playbook. Here is your 6-question pre-trade checklist. I want you to frame these 6 steps not as a gentle suggestion, but as a mandatory sequential procedure you must clear before you ever hit the buy or sell button. Question 1. What is the gamma regime? Are we positive and range-bound or negative and amplified? 2. Where are the walls in the flip point, and what expiry do they live in? 3. What is the vol market telling us? Is IV rich or cheap compared to realized vol? 4. What are the calendar forces? Are we drifting into OPEX on charm flows? 5. Are there positioning extremes? Is the put-call ratio totally maxed out? And question 6, absolutely the most important, what invalidates my trade?
Which brings us to sizing by regime. You simply cannot run the same position sizes in 2 fundamentally different physics regimes. In a positive gamma IV-rich regime, the market is dampened, right? So you trade your normal size, you play high-frequency mean reversion, and you take profits at the walls. But the second you cross into negative gamma and RV hot, the physics completely flip. Moves are amplified. You must mechanically cut your size by 25 to 40% just to survive the increased daily ranges. You trade fewer times, you ride your winners because trends extend, you deeply respect momentum, and you widen your stops. The exact same trade idea behaves entirely differently depending on which side of this dynamic you're standing on.
Finally, we arrive at the 10 commandments of positioning trading. This is the absolute synthesis of this entire course, the baseline rules of survival for reading the options machine. Let's fire through the first 5. 1. Dealers have inventory, not opinions. Their hedging is a forced, predictable flow. Read the inventory. 2. Never quote a level without its expiry. A wall built for tomorrow's 0 DTE vanishes by Saturday. 3. Negative gamma predicts magnitude, not direction. It tells you moves will be huge. It does not guarantee they go down. 4. Every wall is a hypothesis. Price behavior at the wall is the actual verdict. If it slices right through, don't argue with it. 5. The signal is at the extremes. The middle of any indicator's range is just noise.
Let's hammer home the final 5. 6. Opening flow is the only flow that counts. Volume must outpace open interest to mean anything new. 7. IV is strictly a price tag. Always compare it to realized volatility before you go calling insurance cheap or expensive. 8. The calendar is a physical force. Vanna and charm flows, the mechanical hedging as time passes, push the market around just as much as real news headlines do. 9. One signal is a hint, confluence is a trade, but contradiction is a massive warning. And 10. Decide your invalidation before entry. Never, ever, try to figure out where you were wrong during a drawdown.
I want to conclude this explainer with one absolute non-negotiable truth. The market pays traders who know when they're wrong faster than it pays traders who are right. You have the map now. You understand the dealer machine, and you have your daily checklist. Now you have the rules-based process to actually execute. Get out there and put the mechanics to work